welcome to this event, Demystifying Central Bank Digital Currency. And we have Governor Christopher Waller that is going to address the subjects. So this is an event organized together with QUT Business School and the ESA Australia. And we're very proud to have Christopher with us. So my name is Professor Pascalis Raimondos, and I'm the head of school here at QUT. I'm also the president of the Economic Society of Australia and Queensland, so this is a perfect combination. So I'm not going to say a lot here. I'm not going to introduce Christopher because actually we have Christopher's co-author, Pedro, who will do the introduction. But before we do that, we will do the welcome to the country.
Balka be Balka, welcome in the language of the Yagara people. We acknowledge the Turrbal and Yagara peoples as the First Nation owners of the lands of where QUT now stands. For thousands of years, the Turrbal and Yagara people have gathered along the banks of Maywa, the Brisbane River, to share their knowledge and stories. We pay our respects to their elders, laws, customs, and creation spirits. We recognize that these lands where QUT now stands have always been places of teaching, researching, and learning. We acknowledge the important role Aboriginal and Torres Strait Islander people play within our QUT community. From Moreton Bay inland as far as the Great Dividing Range near Warwick and Toowoomba, as far north as the Caboolture River, including the lands around Brisbane City, Meanjin. Yura yura yinala, balka bi balka, nganguru maramakoro nganyabirali, nganyabayam. Welcome to the traditional country of the Turrbal and Yagara people.
Thank you. As I said, Professor Pedro Gomes Porqueras will do the introduction of Christopher. They have been co-authors for many years. So Pedro, you know him much better than I do. Please welcome.
Thank you, Pascalis. It's a great treat for me to give you a few details about Governor Waller. It's kind of hard for me to say Governor Waller when he always tells me to refer him as Chris, but he's going to give us some nice insights on what central bank digital currencies are all about. So for those that you don't know who he is, well, currently he's a governor in Washington, D.C. in the Federal Reserve. Prior to his appointment, he also was Senior Vice President and Research Director at the St. Louis Fed. And before that, he actually spent a lot of time at places like this one, at universities, and he taught for 25 years at University of Notre Dame, University of Kentucky, and Indiana University. He, other than teaching lots of students complicated and seemingly difficult things, he's also been super gracious with his time being mentoring to junior faculty members and researchers, and I personally benefit from his generosity over the last 15 years, and that's such a great pleasure. Other than just being in the policy lines, he's done fantastic contributions to monetary theory, and nowadays he's transforming, among other colleagues at the Fed, what monetary policy is all about, and what new technologies are going to be potentially shaping the way that we settle different transactions. As you'll see in the next 40 minutes or so, it is clear that he spent time in the classroom because he explains things with great clarity. Now, rather than having young folks around expressing the ideas, he talks like this, where we have broader community, people that maybe it's been a while since the last time we were in the lecture room, but he definitely is a great communicator. As an economist, he has done it all. He's been an academic, he's been an administrator, and he's been a policymaker. So in some sense, he has done it all. There's nothing else that he could do. So Chris, the next thing that you could do is basically nice retirement and enjoy coming more to Australia. So it's going to be great. So please, it's a real privilege. Hopefully you'll understand and demystify, as the title of his talk says, what seems to be something that is quite complex, but his ability to narrow down and pinpoint the key aspects, it will hopefully help clarify these things. So without further delay, please let me join in welcoming Chris.
Well, thank you, Pedro, and thanks everyone for coming. This has been a place I've come to many times. This is maybe my 10th time coming to Australia, often to work with Pedro in various places. So it's a real pleasure to be able to be here today. And because I was told I was in Queensland, I could dress casual, so I didn't have a suit and a tie on. So this is a talk on central bank digital currency with the word demystifying, because this turns out to be something people don't really understand. So I thought I would take my governor hat off, put my college professor hat on, and try to give you a lecture understanding what this stuff is and what its potential role is. So central banks around the world are contemplating creating central bank digital currencies, or CBDC. Now, the problem is there's considerable confusion on the part of the general public as to what it is and what it's to be used for. So this talk came out of a speech I gave in August of 2021, where I talked about central bank digital currency, pros and cons for it. When I got done, I asked my kids, what did you think? And they said, I don't get it. What do you mean you don't get it? I mean, they just don't understand the whole basic premise of the thing. So that's what I started realizing when I was talking to them. It's like, why? What was the problem? So it's really two parts, and that's these next two bullet points. So the emergence of cryptocurrencies and distributed ledger technologies like blockchain, which are very mysterious objects to a lot of people in the general public. They hear about it, they don't really know what it is, but it's something techie and something about digital electronic money. And so a lot of times people just ask, is the CBDC just a form of cryptocurrency? So I'll address that in the talk. The other part of the confusion is people just do not have a clear understanding. I'm going to have to, excuse me, this will be about the U.S. structure for the most part, but it applies in Australia too. The RBA is in the middle of doing pilot projects with with CBDC. It's basically the same kind of structure. But it's just the fact that people really don't understand how the payment system works. Payments is this kind of plumbing in the background that just happens, and we don't really understand, or the typical person doesn't understand. So my objective today sounds kind of boring, but it's to describe the accounting behind payment transactions, the nature of digital payments, and the role of commercial bank money, which most people don't even know what that is, but that's what you use every day. Once we get through that part, then I can introduce this concept of a CBDC and how it fits into the current payment systems that we have pretty much around the world. Once we do that, understand what it is, then we can talk about arguments for and against having a CBDC. And so my whole hope is that by doing these first three bullet points, I'll kind of demystify for you what this object is and whether you think we should have it or not. Spoiler alert, it's not Bitcoin. So that's not what we're talking about. This is not going to be a CBDC from every place I've known. It's not going to be anything like a Bitcoin. So let's knock that one out right away. So CBDCs are getting a lot of attention. These are just some news headlines of talking about it. It's all over the place. And so there you go. All right, so I want to think about going from physical currency to digital currency. So we're used to a world in which we have paper, coins, we make payments with these objects, they transfer hand to hand. Okay, so I'm going to just sort of show you what people are worried about. Some central banks are worried about the fact that if their physical cash disappears, what are they going to do? What's going to be their role if the one object that they produce is gone and nobody holds it or uses it anymore? So I'm just going to show you how that happens. This is really simple, but that's what it was. So let's assume if you were in the U.S., you held $100 of U.S. Treasuries, debt obligation of the U.S. government. Do the same thing in Australia. And just for simplicity, you have no other assets and no other debts. So just simple bookkeeping is your assets are treasuries of 100, and that's your net worth, which is always a liability, which if you haven't ever had accounting, it's always like, what do you mean it's a liability? It's something you owe yourself, right? That's how you have to think about it. Now, suppose the Federal Reserve in the US or the RBA in Australia were to say, okay, I'm going to print $100 of physical currency, actual bills, and I'm going to buy your. I go to you, I say, I'll give you $100, give me the treasury bond. So this is what happens to your balance sheet. Your treasuries go to zero. Your currency holdings are now 100. You're holding this $100. Your net worth is totally unaffected by this. You're just swapping assets on this side of your balance sheet. So your net worth is still $10. Now, for the Federal Reserve, what have you done? Well, you've now acquired an asset of $100, and you have a liability of this currency that's outstanding. It's a liability on you. It's kind of an odd liability, to be honest, in many ways. But that's just what happens from this transaction. So now you're sitting there, you have $100 in this physical cash. And you could just put it in your pocket, you could go spend it, or you could go to the bank and just deposit it in the bank. So let's just assume you do that. So now what happens? Well, now your balance sheet looks like this. You have no currency. You have $100 in your bank account. Your net worth is completely unaffected. This is just you moving assets from one asset to another. But now your bank has $100 in currency, and its liability is it owes you $100. Okay, so we've taken cash, put it in the economy, it went from the household to the bank. All right, so what the bank does is it just has a spreadsheet, technically, a database, and it just goes in and with your identifier, it digitally puts in the number 100. Just think of an Excel spreadsheet, here's your name, they go in, there you go, there's 100. And they can put the physical cash in the vault. This is what the old banks did in the old days. They gave you this credit, the cash went in the vault, they locked the vault so nobody could steal it. Now, alternatively, what most banks do in countries is that they typically have what's called a master account at the central bank. So it's their checking account at the Federal Reserve. So let's just assume the bank says, I don't want to hold this cash. I don't have a vault. You put it away. So the funds in these master accounts are called reserve balances. That's just the name we give these things. They're your reserves, and you put them in the central bank. So now the Fed, in our spreadsheet, we say we owe $100 to Bank One, and then we just take the physical currency and shred it. There's no more paper currency floating around in this transaction. It's all now in digital entries and spreadsheets. Okay, so this is basically what everything looks like when this is all done. You have $100 in your bank account with Bank One. You have a net worth of $100. I think I might have had a typo in. I think it was missing a zero before. Yeah, somehow I gave me something screwed up there. Okay, Bank One has $100 in reserves. That's its asset now. It owes you $100. And then the Federal Reserve has $100 in treasuries, and it owes the banks $100. But there's no physical currency anymore. It's gone. All you have are digital entries and spreadsheets for everybody in the economy. So this is what people kind of have in mind when the physical currency goes away. Everything is going to just look like this. So it's just these spreadsheets, and numbers are going to just move across these spreadsheets. Okay, so that's the point. The physical cash is gone. All that's left are digital entries, and we are left with digital money, digital currency. Now, the critical thing to understand in all of this is you no longer hold publicly issued money, meaning money issued by the central bank. Okay? What you hold is a digital claim on a private bank. And that claim is called commercial bank money or privately issued money. This is kind of hard to get people to realize, but your bank account is privately issued money. It's a claim on a commercial bank. It's not a claim on the RBA or on the Federal Reserve. Okay? The bank is the one who's holding the central bank liability, not you. So the way we operate, and this is true in almost all the countries, is that the private banks are an intermediary between you and the central bank. So you're here, there's the intermediary, or your bank, and then the central bank is behind the commercial banks. All right. Now, here's the trick that makes this all work. Your bank, when they issue, you put $1 in your checking account or your savings account or whatever, they promise to redeem 1 unit of commercial bank money for 1 unit of a physical US dollar or an Australian dollar. So you put it in and the bank says, if you come back, we will give you a physical dollar if you want it. Okay? 1 for 1. Okay? Now, what makes that promise credible? Just because they promise it doesn't mean it's just going to happen as a law of physics. Okay? So historically, we've looked in the past and bank customers occasionally got nervous that that promise wasn't going to be honored. And when that happens, you could have periods of stress. People run to the bank and say, I want my money. I want to give up your liability and I want the central bank liability. That's really what a bank run is. It's, I don't want the commercial bank liability. I want the central bank liability. Okay? So this is our classic bank run. We all know what this happens, and you can have runs today. There was one yesterday in the crypto world, by the way. All right. So in the commercial banking system, Congress said, look, we had a big bank run in 1907 in the U.S., a lot of problems. Congress said, okay, we're done with this if we can. And then in the 1930s, Congress created the Federal Reserve, the central bank, to serve as the lender of last resort, meaning you provide liquidity as needed for the financial system. So when people run on the bank and say, I don't want the commercial bank liability, I want the central bank liability, we say, here it is. Here it is. Here it is. Here it is. Everybody redeems. They get their central bank liability, and they calm down, and they go back to the bank, and they put it back in, and they take their commercial bank liability again, and the money goes back to the Fed and disappears, just like I showed you before. Okay? So then in the 1930s, we created deposit insurance. Every country has deposit insurance now, which is basically saying if something goes wrong and the bank does fail, we'll pay you off. Society will absorb the risk and pay you off. And in return, we're going to regulate the banks. That's the trade-off. Your money's safe. The bank will always be able to honor their promise, but we're going to regulate the banks as a result. That's the cost of having this protection. All right. Now, in the U.S., there's not, is that me or is that? No. Okay. There's not been a retail bank run on commercial banks by customers since the 1930s. Okay, so this solution, this combination of lender of last resort and deposit insurance has worked extremely well in the U.S. So what that means is today, households make no distinction between a commercial bank liability of $1 and an actual dollar bill. In their minds, these are perfect, 100% perfect substitutes. Okay? So that's the critical thing to keep in mind is that's what people think. They never have to worry about my commercial bank is not really a central bank dollar. All right. Now, the critical thing, as I showed you hopefully, is the minute you go into this digital world, it's all about record keeping. There's no more physical object at all, okay? So I'm going to touch on some crypto stuff here later, but the balance sheets I showed you constitute a database of financial records. That's all it is. It's just a big database. every database has to have some kind of management system in terms of who has access, who can enter, who can change it, who approves it. Okay, and that's the critical thing, and I'll touch on this later. A critical thing is who has permission to change the records. That is a huge, huge issue in database management. Who gets to go in and actually change those numbers on the spreadsheet? There's lots of ways you can think about it, and that's where we'll get into distributed ledger technology later. So I'll touch on that later. All right, now you can extend this to a large number of individuals in many banks, and this allows you to understand how payments move across banks and across customers. So suppose Pedro wanted to give me $10. With physical cash, this is easy. He just hands it to me. Here's 10 bucks. That's it. There's no record keeping. I just transfer the $10 to him. It's now in his pocket. And there are no intermediaries. Okay, so cash, physical cash, has got this amazing property. It doesn't require any record keeping at all. And there's nobody involved in the middle of this transaction between Pedro and I. But in a world of private digital money, how does this transaction happen? Okay, it's not so straightforward. All right, so in a digital banking world, this is technically how things work. You would send a message to your bank, or I would send a message, or Pedro would. He would send a message to his bank to transfer $10 from his account to my account. You just somehow this message occurs. I haven't said how that messaging occurs, but you send a message to your bank and say transfer. His bank would send a message to my bank saying, hey, there's a payment coming to Chris from Pedro. Do you accept it or not? So the banks have to talk to each other to make sure this payment's okay. Do I really have an account at that bank? That's one of the first things you have to check. And should it be accredited to my account? Okay. Then the way it works is then Pedro's bank would send a message, or my bank, or excuse me, Pedro's bank would send a message to the Federal Reserve and say transfer $10 from his bank to my bank. So the Federal Reserve is just moving money from one bank to the other bank. And after that happens, my bank credits me with the $10. A lot of steps in there. A lot of messages, a lot of stuff has to happen for this to occur. So this is basically what would happen. So Pedro, his bank account would go down by $10. His net worth goes down by $10. Me, my bank account goes up by $10. My net worth goes up by $10. Pedro's bank loses $10 of reserves from the Federal Reserve, but it lowers its liabilities to Pedro by $10. My bank receives $10 of reserves from the Federal Reserve, and then they add $10 to my account, which is their liability. What happens with the Federal Reserves? Well, nothing happens to our treasury, our assets. We're not doing anything with assets. All we're doing is moving reserves around between the two banks. So we're just sitting there taking it from this bank account to that bank account, and we're not buying anything. We're not doing anything. We're just changing the records of what money is in what bank. All right. So all this stuff up here, let me just go back. Whoops, sorry. All of this stuff up here is trading commercial bank money between us. The movement of central bank liabilities is going on down here. So we're all doing all of our stuff with commercial bank money. We're not using dollars. We're using commercial bank dollars. And the Fed is down here moving all this stuff around in the background. All right, so that's that part. This is how almost all transactions in Europe, Australia, the US, everywhere, Japan, that's the bulk of transactions, or the way I just described it. All the central banks are doing is sitting kind of in the background, just making sure the money gets moved from the banks in a way that makes sure everything clears and settles. Okay? So the private banking system does the bulk of the record keeping and digital payments. They're keeping all the records of your accounts. They're making sure all these accounts add up and are clearing. So they are the trusted record keeper of all financial transactions that they control. Okay? Why do we trust the banks to do all this record keeping correctly? I said it already. We regulate them.
According to some audit strategies, people are more likely to trust you when they believe you're actually.
Siri's listening. Okay, so most of the transactions we do, the banks are the trusted record keepers. They're the ones who have access to change the records. You do not. You just send messages to the banks, and then you can look at your account to see that it has happened or it hasn't. I can't go look at Pedro's account. I can only look at my own account. All right. Now, there's also another central trusted record keeper, which is the central bank. The Fed, the RBA, the Bank of Japan. We're in the background doing all the clearing and settlement across the banks. We're the plumbing in the background. That's how to think about what central banks are doing. We're just the plumbers. I am not directly conducting payments on Pedro's behalf of mine. The Federal Reserve is not, or any of the central banks are. Okay? It just lets the private banking system do all the work. We let the banks do all this stuff, and then the Feds and the central banks just sit in the background and just make sure all these bank accounts settle across the banks. So every central bank, the Fed, is a trusted record keeper in this current system. So we have trusted record keepers of the commercial banks and the central banks. Okay? Now, without jumping too much ahead, none of that changes by introducing a CBDC. I just want to make this clear. None of this changes. This trusted centralized record keeping by the private banks and the central banks, that's all still going to be there if you have a CBDC. All right. Now, if you just look back at the balance sheets I showed you a minute ago, I'll just go back real quick. Look, there it is. You kind of look at it and go, do we really need this step? Why can't we just, Pedro and I do this right through the central bank? So why can't we just do it ourselves? Well, the first one is, why do we need anybody? Why can't we just do the first layer, like cash? I take cash, I give it to Pedro, there's no intermediaries, that's it, we're done. Why can't we do that digitally? Second, why can't we all just have master accounts at the central banks? If the commercial banks can have master accounts, why can't we individually just have master accounts? And then we don't need the banks. We can just do it all through the central bank. Okay? So those are the two things that when you look at that kind of complicated movement of stuff, that's what happens. And so you ask these two questions. All right, so the answer to the first question, if Pedro and I wanted to do some digital transaction just directly between us, you would have to have some kind of digital object that acts effectively like physical currency. Right? I give Pedro $10, and a physical object, we're done, that's it. How do I do that digitally? Now, this is a critical thing. Physical cash is an anonymous bearer instrument. I give Pedro the $10. He doesn't need to know who I am. I just walk in, I go to the bar, I order a beer, they give me a beer, I give them $10. I don't have to exchange my identity with the bartender. I don't have to tell him anything about my life, my birth date, my, ID numbers of any kind. There's no record keeping. The problem, and this is kind of what cryptocurrencies are trying to replicate. Okay? But they're digital. And digital requires record keeping. There's no way around having a digital object without some kind of database management. So it has to have it. And that's what a blockchain does in the cryptocurrency world. It's the form of record keeping for transactions between Pedro and I. So what you do in the crypto world is you have something like a tokenized bearer instrument. It's a digital string of numbers. It's like, that's the equivalent of $10. I pass it to Pedro. We send a message. We put this in a pool, and some miners validate the transaction. It goes up on the blockchain, and everybody sees that I transferred $10 to Pedro. Okay. All right. So that's all a blockchain is doing. For those that don't know much about the crypto world and don't really care, if you take away one thing, that's all the blockchain is doing. It's just tracking ownership of Bitcoin. That's all it's doing. Who's got it? Now, the whole concept of Bitcoin is it's based on a complete lack of trust. Our current commercial banking system is built completely on trust. We trust the centralized record keeper to make sure all these things are recorded properly, and they're done. I just check my account to make sure my thing looks right. I don't get to check Pedro's. But the whole idea of Bitcoin is I don't trust anybody. You don't trust anybody. How do we operate in a world where there's no trust? Okay? So record keeping is done in a decentralized, permissionless manner via consensus. Okay? So Pedro and I, we do the following. I say, I'm going to transfer $10 to Pedro. We ask all of you, is this a valid transaction or not? If you all agree, it gets recorded. Everybody can be in on the decision. Anybody can validate the transaction. There's no special single person who does it. So anyone, I've lost track, can't even see it now.
I can put it on the two screens only.
Oh, yeah, we might want to do that because now I can't even read what it's big enough to read.
I don't know.
That came back. Pretty small.
Yeah, no.
Maybe put it up top and go across, if that's possible. 2 panels.
Hitting it.
Yeah, that's not gonna work. Guess we'll just have to go with that.
Yeah, the best you can.
Oops. Yeah.
Okay.
Click the slideshow or whatever if it'll do it.
No, it's okay, Chris.
Just go there. Yeah.
Yeah.
Okay.
There you go.
There we go. Okay. So this is, I'm just trying to take a moment because there's a lot, like I said, there's a lot of discussion about crypto, distributed ledger, all this stuff, and it gets mixed up in central bank digital currency. I'm just trying to help you understand what these things are doing. So with Bitcoin and the distributed ledger blockchain, anyone can have a copy of it. So think of a spreadsheet with transactions. Anybody can download it and have a copy. What does that do? It means one person cannot corrupt the database because everybody's got a copy. You can corrupt mine, but Pedro's got one. Everybody's got one. And if you corrupt mine, it doesn't matter. Everybody's got the copy of it. So this is where it's censorship proof. This was the whole design of this thing, was that one person, one government cannot get rid of it. It's there. It's unavoidable. You can't stop it. Okay. And anybody can propose a change to the ledger. It's just, as long as the group agrees to the change, it happens. By the way, it doesn't have to be true. We could propose something that's completely false, but as long as we all say, good enough, we'll take it, it becomes fact. Okay? And so anyway, this is why blockchains are referred to as permissionless, meaning anybody can propose a transaction, and it's distributed across everybody. Everybody has a copy. That's kind of what the language means. All right, that's a kind of a sidetrack to, whoops, now I've lost my. Whoa. Nope.
Bulka be bulka.
Oh, right there. Oh, no, a couple more. Keep going. Oh, back up, back up. Okay, oh, and I guess, nope, I got to keep going. Yeah, you might as well put it in full screen mode or slideshow mode, and I can just go through it. Whoa. It's frozen. It's frozen. It froze. I don't know what happened. There we go. Okay. So this is what the whole blockchain permissionless censorship-proof stuff. All right. So when most people hear of a central bank digital currency, they envision something like Bitcoin, which is a digital, tokenized, anonymous bearer instrument. That's what they think when they hear the word central bank digital currency. Now, a central bank could construct something like this and put it out for trade in the crypto Ethereum world. But if you did that, you're going to make money laundering, tax evasion, and all kinds of other illegal activities really easy, right? That's why they like to use cash. It's because it's anonymous and there's no trackers and that's why you like to do all these things with cash. Okay, so I am not really aware of any central banks that are seriously considering a tokenized bearer instrument for a central bank digital currency. Okay, so the language that people say is what everybody's considering is an account-based CBDC. Not this tokenized thing, an account-based CBDC. And that brings us to the second question. Why not just open an account at the center? Instead of going to your bank, why go to a Commonwealth Bank, just go to the RBA and open an account. So if you thought about doing this, you could do it two ways. One is called a direct access account, and the other would be an intermediated account. The intermediate account meaning you still go through your bank, but instead of having a checking account on commercial bank money, you have a second one that's on central bank money. So you're still going to your bank, you're still doing everything. It's just you got two different checking accounts. One's directly with the bank and the other one's directly with the central bank. All right. So the funds in these accounts are liabilities of the central bank and are called general purpose central bank digital currency, or CBDC. And they can be used to make retail payments between households and firms. Now, when I just did this example, I told you about bank reserves. Bank reserves are already a form of CBDC. The language they use is these are called specific purpose. They're only used for transferring funds across the banks, nothing else. So they're very narrow in their focus of what they're doing. Okay. Now, an account-based CBDC would be the following. You have a direct account with the central bank, and you directly interact with the Fed to conduct payments. So the Fed would create like an app. You put it on your phone. I want to transfer $10 from my Federal Reserve account to Pedro's Federal Reserve account. Okay? That would be it. That's the simplest form of CBDC. It's just like your bank account, except it's at the central bank. Now, the intermediated CBDC, you have to go through kind of a wallet provider. Now, it could be your bank. It doesn't have to be through your bank. It could be somebody else that says, I'm going to have you operate and make messages and send it to the central bank. Okay? And so, with a direct access CBDC, if you want to pay me $10, you just send a message to the Fed, it says transfer it across, and you're done. The Fed would double check all the usual stuff, and the payment would be made. And this would be what would happen. You want to pay me $10, your bank account at the Fed goes down by 10. Your net worth goes down by 10. My bank account at the Fed would go up. My net worth goes up. And all that happens is at the central bank, your CBDC account would be debited and mine would be credited. Looks just like what you did with the banks, except the banks are gone out of that transaction. It just took the middle layer out. Okay? So this type of account allows one to completely bypass the banking system. If you really hate banks, you'd probably love this. All right. So as I said, an intermediate CBD account is I basically have a CBDC account with my bank. I would send my bank a message and say, take $10 out of my CBDC account at my bank, send it to Pedro's bank, and put it in his CBDC account. It sounds just like what you're doing right now. But what are you gaining with this intermediated model? Okay, so that just sounds like the current banking system. It's just kind of a weird checking account. But other than that, it works just exactly the same. So what are you really gaining? Okay, although transacting directly with the Fed is simpler, is it better? In other words, the existing banking payment system works relatively well. I mean, we don't seem to have a whole lot of problems with making our payments. So what are you gaining by doing this that you don't get in the current system? This is how an economist would look at this and say, okay, what are you adding in value by introducing this thing that you don't already have? So for the remainder of my talk, when I gave this speech back in August 2021, my speech starts here. So if you didn't have all of that background, now you're going to listen to me talk about this in a speech. Okay. All right. So here's the debate around CBDCs. Now this is the public policy debate. Hopefully I've kind of explained this enough to you that you kind of get it now. So is a CBDC needed to expand financial inclusion? This is what people say all the time. People don't have bank accounts at the commercial bank. We should give them an account at the Fed. And then people are tied into the payment system. So that's the first point. The con is I'm just speaking for US data, only 5% of US households are unbanked. There's a difference between underbanked and unbanked. Underbanked means you have a bank account, but you use other things like payday lending or other things outside of the bank that involve payments. And that is not going to happen. We're not going to do payday lending at the Federal Reserve, I can tell you that. Only 5.4% of U.S. households are unbanked. And if you ask those unbanked households, how many of you want a bank account? It's only 1 in 4. So you're down to about 1% of U.S. households are unbanked and want a bank account. So a CBDC seems like a very complicated way to get that 1% into the financial system. You'd be better off just subsidizing an account with a commercial bank than building this monstrosity payment structure to do all this. One of the things people say is a CBDC needed to lower payment fees? People complain a lot about fees that cost to process payments. So by providing an alternative to banks, fees for payment services will be competed down. Now, this may vary across countries. This is my own philosophy, kind of an American view of things. It's not my job to compete with the private sector to drive down payment costs. That's not what I was created to do. Okay? Let the private sector figure out how to compete and drive down cost. You don't need the central bank to do this. So I've kind of made the example. If everybody wants to have electric cars and we think this is valuable for the planet, and you look at a Tesla and it's $75,000 to $100,000, I don't hear people saying the government should be building electric cars to compete with Tesla and drive down the price. I do not hear that ever. Okay? So this is what's kind of weird. It's like, why is the one time we want the government to directly compete the Fed in payments? It's kind of what is the point? Is a CBDC needed to foster financial innovation? One of the arguments is if you create this thing, think of all the innovation that's going to happen as people now think about creating wallets and all these things to interact with it. I'm going to tell you right now, there's more financial innovation going on than I can possibly keep up with. The full fintech sector is exploding, just exploding. And we're having a hard time as regulators keeping up with it. So we're in a world where there's already a tremendous amount of innovation. So you don't think there's enough? You have to have a CBDC to have more innovation? So I have never found this a very appealing argument. Is it needed for a faster payment system? So one of the complaints about payments is they tend to be somehow slow and clunky. As I showed you, payments can occur a lot faster with a CBDC because you're cutting out all this intermediary level. Okay? But the thing is in almost all countries, real-time payment systems are being developed that process payments in seconds. Okay? So there's a private sector one in the US called real-time payments. The Fed is building one called FedNow. But that is all occurring without a CBDC. You don't need a CBDC to have real-time payments, where you make a payment, it's transferred and recorded in 2 seconds. Done, finished. So you have to, again, separate out speed of payments from the need for a CBDC. Is it needed to reduce cross-border payment frictions? This is probably the single most thing I hear constantly with a CBDC. International payments are costly. They're slow, they're opaque, complex, and I'm not going to disagree with it. The only thing I'm going to point out is a lot of that complexity is put there by regulators. It's this stuff called money laundering, tax evasion, terrorist financing. That's why these things are slow and checked and checked and checked and checked. So are you assuming the central banks are not going to do that? So that's why they're so fast, because they're not going to do any of this background stuff. So there already are international efforts underway to simplify and lower the cost, and it's all happening without a CBDC. If we never have one, this is happening. This is what private sector innovation does. So one of the big things, at least in the US, I don't know about down here, is a CBDC needed to counter the threat from stablecoins? So in the crypto world, they have created effectively a replica of a commercial bank deposit or a dollar, US dollar. So you basically say you give some crypto stablecoin issuer $1, and then they give you a stablecoin and say, you can redeem this for $1 on demand. Sounds familiar, right? You bring it in, we'll give you your dollar back. Sounds like exactly what banks have always said. Okay? And the fear is that these stable coins in these kind of crypto world are going to undermine the US dollar as a reserve currency, and then also affect the effectiveness of US monetary policy. So like I said, many stable coins peg their value to US dollars, just like banks do. They back them up with relatively safe liquid assets, kind of a money market mutual fund. So they're really not very different from a bank account, except for this one thing. They don't have deposit insurance backing it up. So you can run on stablecoins. And we saw that earlier this summer. We saw stablecoins collapse and did not have assets backing it up. We saw runs on Tether, which did have assets, but people weren't so sure that it was actually going to work. Okay? So this is where there's discussion about with appropriate regulatory oversight, they would be safe payment. instruments. You can do this in a way that these stable coins on the Ethereum, the crypto world, these things would effectively act like US dollars and be safe as US dollars. Now, this one again, I was just recently at Harvard on a panel discussing the role of a central bank digital currency in national security. So I hear this argument all the time, particularly in Congress, when I talk to senators and representatives. China has a CBDC in place for about a year now. And the argument is this would threaten the reserve currency of the US dollar. Now, I want you to understand what this is. This is a checking account at the People's Bank of China. That's what it is. You can pay with Alipay, WeChat, or pay through your commercial bank, or pay through the central bank. I can't understand how that is going to undermine the reserve currency status of the US dollar. Furthermore, why would non-Chinese firms... Question.
Yeah. So, my name is Michael Knox, and I'm Chief Economist at Morgan's Financial, which is a local stockbroking firm. We're the largest in the state, 7th largest in the country. I spent the first third of my career in Australian Foreign Service, and in a whole bunch of countries in which the US dollar was a parallel currency. I think that if I was seriously advising my clients and they asked me, is this country going to go to war with China in the next 10 years? I would say there's a better than even chance that this country is going to be at war with China in the next 10 years. Perhaps with the United States, perhaps because, we didn't have a choice. So in that circumstance, it's very rare that countries in the world are in the circumstance of being like Australia or the United Kingdom or the Canadian dollar, of having their own reserve currency, having their own country was a reserve currency, which is held by other countries. But pretty much everywhere I lived when I was in the Foreign Service, there were people who had the US dollar as a parallel currency. Had, in the corner of their bedroom, they had a safe with a whole bunch of US dollars in it. And those people still do. And so what's going to happen when this event occurs, when there's better than even probability of war against China occurs? All these other countries are going to need, all these individuals in all these other countries are going to need somewhere to go to with their individual assets.
Right.
Now, in that situation, China is offering a digital currency as a country, place they feel they can put money into, apart from holding bags of diamonds to go from country to country or something like that, or gold coins to go from country to country. So in that circumstance, which is not beyond probability, it would be a really, really good idea if there was a US dollar competitor to what the Chinese are trying to do here.
Right.
So if you are somebody who's trying to flee Vietnam, where there's 100 million people, or if you're somebody who's trying to flee Thailand, or you're somebody who's trying to flee Indonesia in that circumstance of war, you have a US dollar, a form of US dollars you can readily seek so that you can escape the event that you've been
that's what I'm trying
possessed
to.
by.
What you're describing is a tokenized dollar.
Yeah.
These are not tokenized dollars. These are checking accounts at the central banks. So you would have to say, we would allow every citizen in Vietnam to have a checking account at the Federal Reserve. That's never going to happen. That's never going to happen at any reserve bank. Countries wouldn't allow it. So that's what I'm trying. That was my point, that all the CBDCs being considered, and China's included, it's a checking account. It's not a tokenized object that you can hold at home and transfer through some blockchain outside if something bad happens. That's not what these are. That's where the problem comes in, that people get confused what these objects are. So, and that's my point here. If we offered U.S. citizens the ability to pay their electric bill through the Fed as opposed to a commercial bank, how is that going to protect the reserve currency status of the dollar? It's not. These are not things that do anything with reserve currency status. If we allowed all foreigners on the planet to have a checking account at the Fed, you're right. We would be the dominant currency everywhere for everything. But that's not going to happen. We would not do it. Congress would not let us do it. Governments would not allow you probably to do it. So that's, I mean, people have in mind that what China issued was a tokenized bearer instrument, like cash, and they are not. That is not what they created. And they have no intention because they want to monitor all of your financial transactions. And you cannot do that with an anonymous bearer instrument. So that's my point. You've got to separate account-based from tokenized bearer instruments. And no central bank is talking about doing the first one. So I'm concluding, I'm done. I've been blabbering way too long. So a CBDC allows households to bypass the banking system. So I always ask, what are the public policy reasons for disintermediating the banking system? You may want to do it, but I want to know a public policy reason that this is important to do. If you were to have and by the way, we are not going to allow direct access at the Fed. That's already been ruled out because of this bullet point right here. But the direct access CBDC, the Fed would take on enormous cybersecurity risk. Because to do this, you have to connect to the internet. And the minute you connect to the internet so that you can on your app and your phone tell me to make a payment for you, you have opened up the Federal Reserve's balance sheet to the entire world. The way it works now is we have a closed loop system with all the banks. It's not accessible from anybody from the outside. So, okay. So that's the point why no central bank will talk about a direct access. They're really not serious because of the cyber risk involved. And with an intermediate, I'm trying to read the last line. This is the whole thing about wallets again, and having a bank, an intermediate. I just lost the screen. I'm down to about my last two slides, I think. Okay. Anyway, we'll just go to this one here. So this is a question I posed in the speech last year. It's a challenge to everybody that wants to push for a central bank digital currency. What is the major market failure that exists in the payment system that requires a CBDC and only a CBDC? I laid this challenge out a year ago. No one has answered it. And so this thing, why should the Fed become a direct competitor to the banking system? We do not do this with any, at least in the US, we do not do this in any other aspect of the government. Why are payments the one thing we want the government through the Fed to step in and do? Okay. So CBDCs, my last point, they're of great interest. Every central bank around the world is exploring it, playing with it, thinking about it. But the case for adopting one is not yet convincing to me and many others in terms of doing it. And I will stop there. Went longer than I thought. Sorry.
Yeah, thanks, Chris, and sorry for this. I mean, it happens, and we talked about it, that it happened in the conference, but it happened again. So sorry.
That's like the Star Trek show. Technology always fails.
Great. Look, there is time for questions, and there are a couple of microphones around, and we will give the microphones. Natasha has one, and I'll have the other one.
Hi, thank you for your talk. It went in a direction I didn't expect. So. But I think it's really interesting. My job is to gather data about cities, about financial innovation, and do rankings of cities and things like that. And what I find interesting is just the question of system resilience. So the screen there is not resilient. Technology is not resilient. Databases are not resilient.
Right.
So what's the case for... Cash is resilient in some ways, but it's not resilient and it gets burned. So what would be some sort of compromise, or what do you think is the likely outcome that the US might find in this, or what's sort of because it's horse trading in Congress, what's the likely outcome, or what's a possible outcome that's being talked about as So why?
Yeah, so resiliency is what every bank on the planet has to worry about, right? Your record database has to be non-corruptible, it has to be backed up. We worry about cyber risk, hacks taking over your databases. So this is done every day by the private banking system. And so far, they seem to do a pretty good job of it. So again, why should I be stepping in and trying to replace banks who do it every day and do it well? In terms of happening in Congress, there was a debate in the U.S. whether we have the authority to just go ahead and do it. Chair Powell kind of pointed out that, this is really a decision for Congress to make. If they want it, we'll do it. If they don't want it, we're not going to do it. But it's not up to 7 unelected people, me being one of them, that makes this decision for the entire United States. So it's up to Congress. Congress is debating it right now. Some want it for competing directly with banks for whatever reasons. Others think about it for national security. Others are like me, very skeptic that we really need this in any way, shape, or form. So we'll have to see, but I don't think anything's going to happen in any near future for this.
Yep. Brendan Markey-Taylor from the Westpac Commercial Bank. First question, I can think of one very large market failure that government would want to rectify with one of these, but that's for another time. The second one is I sit in the commercial bank. I work with transaction bankers who are involved in this stuff, but I sit personally in the credit side of the bank. So you've talked a lot about the payment system here, but on top of that is built the credit system. Right, so the money multiplier and all of that. You thought through the implications of what this looks like. Does it look like the government getting into commercial, institutional, SME banking to operate the money multiplier? Or are we looking at the disappearance of the credit cycle? What are we looking at here if they introduce one of these?
Right, so one of the things we have to keep straight when we think about a bank is a bank does a lot of things. It does payments, it does credit, it does lots of other things. Milton Friedman in the 1950s pointed out that one of the problems with bank runs is when the bank run goes down, the payment system goes down. So his argument was separate the payment system from the banking system. Have a system in which there were things called narrow banks, which by the way are stable coins for all intents and purposes, and just let people make payments with stable coins and all the credit stuff is separate from the payment stuff. So that was the argument from Friedman back in the 1950s, is how to protect the payment system from banking. The thing is, because of the lender last resort and deposit insurance, this hasn't been a problem in 80 years. When Friedman was writing about this in the 1950s, he just watched 15 years earlier in the 1930s, everything collapsing. So, nowadays we don't really think about it too much, but this is what you're seeing in fintech. You think about things like PayPal and Venmo. These are not credit extending firms. They're just doing payments. You put your money in a Venmo account, it gets moved around people in a closed loop system, but there's no credit really extension. There's nothing big along those lines. They're just making payments. So I think of a lot of what fintech is doing is they look at banks and they just take this little task away and say, I can do that better, more efficiently and cheaper. And payments is one that they're tackling.
There's a question here. I'm sorry.
Chris, very interesting, Chris. Thank you very much. I don't know if it's working, but it doesn't really matter, I think. Okay. I think it's I can not loud enough. But thank you very much. One of the reasons, of course, of the key reasons why we've got the reason why we go to digital currency is that it can take out a very significant part of the cost of doing business. Yeah. And so you cannot, in my opinion, you cannot stop it. Perhaps, it takes a while, regulations and all sorts of stuff, But, if you look 5, 10, 15 years away from now, then digital currency, is going to be a key reason. The reason why we want to take cost out of the economy. Yeah. Sure. So in a situation like that, do you see that could undermine, the whole banking system, of which the Reserve Bank, of course, is a very important element,
Right. So that goes back to what I was just saying, which is taking the cost out of this is kind of what the payment system providers like Venmo and others are trying to do. I don't need to have costs of payments cross-subsidizing other parts of what banks do. Cut that out and I can drive these costs down tremendously. So, but that has nothing to do with me. That's what the fintechs are doing and fighting with the banks. That's what the private sector does. I'm not here to pick winners and losers. That's not my
Don't you see
job.
the future of currency, digital currency, going in the direction of that over the next 5 years?
We already have digital currency. It's called commercial bank money. And we've had it for 50 years. This is this word that people think is somehow really new and exciting. We've been doing digital currency with commercial bank money for 50, 60, 70 years. It's just somehow it gets caught up in crypto. That's the problem.
There's a question here.
Yeah, so you mentioned that the current system effectively functions like a CBDC between the banks and the Fed.
Yeah.
And you also mentioned that cash is primarily used for your illegal activities. So do you see a future where the Fed will stop printing physical cash and then relying wholly on this digital system that we've got right now?
Yeah, I mean, there's a lot of debate about this in the U.S. As far as we know, until Congress tells us to stop doing it, we're going to print physical cash. It's stunning to me in the world where everything's going digital, our currency grows at 7% a year, steady, year after year after year. And I'm like, who is holding all this stuff? Because everybody I know doesn't hold any money anymore. They just do everything digital. But somebody in the world wants like blocks of $100 bills. Pretty sure I think I can have some idea what it is, but it's really Congress's job to say, look, you're done printing physical currency. It's not my job to make that decision. That's Congress's job. When they tell me to do it, I'll do it.
There's a question at the back.
And that was kind of what I was going to touch on. But as a little bit of an anecdote, I wrote to our federal treasurer, Joe Hockey, in 2014 to challenge him to take currency out of the system. And still waiting for his reply, by the way. But when you talk about market failure, which is one of the things on your slide there, is broadening the tax base by taking the black economy out of the equation, as well as removing drug dealing and so on. Is that another sort of social element of market failure that a CBDC might in fact correct in the fullness of time?
So this is exactly where these things start getting all mixed up. You can get rid of currency and you don't need a CBDC. You're just using your commercial bank accounts. All you need is the threat that if you want a physical dollar, the Fed will be ready to hand it to you. They don't actually ever have to do it, but it's just the promise that if you want this physical object, I will give it to you. That's it. You don't actually have to provide it to people. So that separating digital payments using commercial bank money versus physical money versus CBDC, that's what I'm trying to sort out today. Is these are three different things, and some of the things you just pointed out, you could do without a central bank. They've been talking about this for 40 years before a CBDC ever was talked about. So the whole idea of getting rid of cash, doing all this, bringing whatever into the official tax system, yeah, I mean, you don't need a CBDC to do any of that.
Now, two more questions. Gentleman here.
Thank you so much for your talk. I like how you played devil's advocate with your pros and cons, addressed some of my other questions. I was just wondering, my question is, what role do you think privacy plays in a system like a CBDC? I know you mentioned China. It's great. China's a great practical example of implementing CBDC. Of course, not shining stars in human rights and privacy laws. So what role do you think privacy plays in a system like this?
Oh, it's huge, huge, huge. This is one of the big issues was, like, once the central bank is monitoring people's direct, like you do your transactions with your bank, and if Congress wants your information, they got to subpoena the banks, and then you have to go through the courts to get it. It's not clear to me, I'm not a lawyer, so be careful, it's not clear to me whether the same rigorous standard of getting financial data, if we were collecting it, applies. Now, I've been told by some people it does. It doesn't change anything just because it's us. But there is a real sense that people do not, that's why I think no one will ever use the damn thing. Because you're sitting there going, geez, I don't like banks already. So people who are afraid of banks and they're going to trust me? It's unlikely. People who don't trust banks don't trust banks. So, but we worry this is extremely important. Like, how do we make sure privacy, if you're doing your transactions, I can't step in and say, I don't like you doing that transaction buying a gun in the US. So I'd like to censor that transaction because I can do it through the central bank. So these are the kind of things people worry about, that if you have this ability to do transactions and monitor, that you can kind of start controlling what transactions people can do. And that's where the privacy thing really becomes important for a lot of people. So we worry about it. If we ever went down that road, that would be like one of the top things we would have to sort out.
In Australia, a few years ago, we had a bank, in trouble with, laundering money for child prostitution, I think, away from the CBDC, but how are the regulatory agencies, because digital currency Bitcoin is like a new thing, how are they keeping up with the regulations? And I can see, they've got two things to look at: organized crime and external threats. I mean, what to say, Vladimir Putin can't bring the whole system down.
Yeah, so again, the things with anti-money laundering, tax evasion, terrorist financing, the banks do that already. These things about money, if a bank does it and you get caught, then people, go to jail or get kicked out of the financial industry. Again, that has nothing to do with the central bank having this electronic checking account. If you were interested in doing those things or wanted to play in the shadows, you're not going to go through a central bank to do that. So that's not going to stop anything unless you literally told everybody you have to run through the central bank. We're going to kill the commercial banking system. That's not going to happen.
Great. Thanks a lot, Chris.
Thank you.
Everybody. Join me, everybody, to thank Chris. There will be more time to go outside and enjoy a light refreshment and a drink, and I'm sure Chris will be here. So please, the ones that wanted to ask more questions, just approach him. Thank you. Thank you, everybody.